Welcome to an episode of my Voped podcast. This episode I'm going to do in the category I titled Politics, Finance, and Economics. The reason why I put those three together is because these days, and in fact throughout most of history, you really couldn't get away from it. Politics directly affects economics, especially on a macro level, which then inherently affects businesses and operations, especially when you get into taxation and regulation. And of course, that all plays into finance and how things are financed, loose capital, when you have loose credit systems and low interest rates like we have now. But what I wanted to talk about today was, I had done a couple of articles and a couple papers, but it was on gold, inflation, and commodities, because people don't really seem to understand this. You listen to a handful of students of the Austrian School of Economics, and they seem to get it. And the MMT, the Keynesians, they don't really understand it. They don't really get it. And people have this misconception of what gold actually is, and actually the whole concept of hedging in the first place, I think. So I'm gonna try to explain a little bit about this. Anytime you do a model in economics, the whole idea is to strip away everything to the base. Once you get to the base, it kind of mimics a whole lab environment where you're trying to do controllable variables. So the idea is, if you completely simplify something that's going on, then as you add stuff to it, you can actually examine what happens when you add stuff into a model, and that's what economics tries to do. The major issue, though, happens that economics is a behavioral science. It's a social science. It doesn't matter how many numbers you try to put into it. Economics is always going to be driven by behavior, and what I mean by that is people's acceptance of things. People value items, and that actually is a behavioral construct. Like, you can see it in luxury goods. Luxury goods would never have the value they have if so many people didn't want the association with owning the luxury goods. That's placing a value on something. It's not just the good itself, and that's where the pricing comes into play. But that's kind of something for a different episode. But you get the idea, like, hopefully. And so economics is a social science. You cannot really model stuff effectively without taking that into consideration. And modeling behavior is extremely difficult to do, especially when you get in times where people are in the whole what's the book, Popular Delusions and the Madness of Crowds, I believe, is the book. But as a crowd mentality, people change. They go kind of off their rocker. They lose their independent thought ability. And momentum trading is a good example. Once you see people, or once you see a stock price going up, everybody piles into it, which obviously drives it up. It's momentum trading. And then somebody who has a huge position, when they see it drive up, they'll dump a whole bunch on the market, and they'll hopefully get a good percentage of profit. And then the price will kind of dip. But if enough momentum is going along and people are still buying it, it'll carry it as it's going along. And so you're going to be able to maximize the price that you get when you're selling on that momentum market, and that's where momentum trading comes in. But it's a behavioral issue, because whether or not that stock is actually worth the price that is being bought at is a completely different issue altogether. And so to understand that's kind of where people lose that idea when it comes to economics. And so when they're throwing all these charts and graphs at you, you always have to bear that in mind. It doesn't have to be rational, because people's behavior isn't always rational, especially when it becomes a mob mentality. And that's something to keep in mind. So now, rolling back to commodities and inflation, and going to the simplest idea, we're going to go right back to bartering and trade. And this will kind of bring in several things. But if you consider the fact that some of the earliest bartering systems, you would have been perhaps farming and grain, fishermen, way back salt mining was a huge commodity as well, because salt is needed for life. A lot of people don't really realize that. There's a really wonderful book written, it's titled Salt, but empires were built on that, and that used to be kind of a form of currency. And so bartering and trading, obviously you trade the goods that you have, and we can get into whether you're good at doing that or whether you have the resources to do it and so on. But for right now, just look at the bartering and the trade. And so you trade your goods for something else because you see value in it. And the value can be a need, or the value can be something like a luxury good that you really just want to have because it's something that's cool, or you think that it's useful. But nonetheless, you go about trading your goods. Well, if you're the farmer, you realize really quickly that once you do a harvest, your commodity goes bad really quickly comparatively to other commodities. And if you were to rank commodities, you would see that you have certain ones that have very short lifespans and ones that have longer lifespans. And so if you have a shorter lifespan, all of a sudden you had to kind of start to figure out, well, I've got to make the most of this. Otherwise, I'm just trading all my stuff in one harvest. And, laws of supply and demand. If you have a whole bunch of it, you're not going to get the best price for it. And you see this in cyclical or seasonal commodity trading, especially in agricultural products. And so way back, you would have had to try to figure out a way to do that. And so you would trade with somebody else who had something that had more longevity. Perhaps you're going to trade with somebody who, has some timber, or somebody who has some copper, or somebody who has coal, or something like that. And you're going to trade for something else that you can hold for a little bit longer, and then use that to trade along the way. And so that in itself was kind of the first looks at using something as a medium of exchange, like money, for example. The whole idea of money, though, is exactly that. It has to be able to be measured. It has to be a unit of account, basically. Some things you can't measure. It has to be fungible, which it has to be basically the same thing. I tend to bring up steel as an example, because there's different grades of steel. Well, that won't really work very well because there's different grades of it. But if you use something like, everything's got different grades of stuff, and so that's kind of an issue. You've got different grades of different kinds of vegetables. Even corn has different grades. You probably have different grades of coal. I'm not sure. I don't really know that much about the coal industry, but I'm sure you do. There's different grades of oil. So all of that makes sense that you would have different grades of things. And so it's got to be something that's similar. Otherwise, when you're going to trade with somebody, it's got to be readily able to be verified, counterfeiting and so on. And then it's also got to have some kind of it's got to hold its value. It's got to be at least to be able to hold its value, or be able to be traded at a rising value. It can't really depreciate. That's where our cash, our currency that we hold, it's a debt instrument. It is not money in that classical sense, and it doesn't really represent that. Part of that comes into the fiat system, which is, there's a whole history to that. But for right now, let's just look at the commodities and the trading. And so the first instances come into play because you're looking at the goods you have, and you're trying to get the most life out of that trade or that supply that you have. And that's really where, money kind of came into play in the first place. Exchanging for something else that had longer life than what you had, and trying to make the most of it. Therein actually comes in kind of like they always say, the mother, or necessity is the mother of invention. And so if you were able to figure out that salting or pickling fish or pickling vegetables enabled it to last longer, Well, then all of a sudden, you create a new market for a method. And so that's actually using a commodity and creating a value added method. And so that becomes more valuable than just simply the commodity itself. Another point to remember that commodities are baseline. Anything added to that afterwards creates benefit and value. And if it doesn't, then the market will shush it away. Nonetheless, going back to the fact that you're looking at something to extend the life of the supply that you have to trade for. If you go about stockpiling different supplies and you thought you were safe stockpiling lumber, or you thought you were safe stockpiling iron or copper or something of that sort, all of a sudden you begin to find out that, well, lumber's got a life, but it's only a little bit longer than the life that I have with my ag goods, because it starts to rot, especially in wetter climates. Copper oxidizes. So does iron. In fact, iron might do it more quickly than copper. You begin to find out that in order to do some kind of a trade, you need something else. It can't be something that rots. It can't be something that degrades. It has to be something that meets all the requirements that I was talking about. And that therein goes to gold and silver and the noble metals, basically. Now, if you want to know why gold, that right there is why. Gold, number one, was able to be, it's extremely malleable. It's got beauty, and craftsmen can work with it. And so there's inherent value in actually being able to use it. But not only that, but it doesn't oxidize, it doesn't corrode, it doesn't break down. The tarnishing that you see in like a gold or silver generally comes from, I believe they add nickel to silver, and I forget what can be added to gold, but nonetheless, it's whatever's added to it. These metals themselves don't. If you have bars of gold and you have them stockpiled somewhere, 100 years later, you're going to have gold. But if you try to do that with food, lumber, copper, or iron, if you've ever seen anything with iron, if you have gardening tools or something like that, granted, they're, certain content of iron, but they're rusting, and you see this. But gold, no, it doesn't. It lasts. Now, extending that into a trading situation, not only does gold last and does it have value and beauty and is easily workable, but you can test it to see that it's pure, and you can test that, and it's actually fairly easy. Not so much nowadays. I believe it's either hydrochloric or it's nitric that you use for gold purification. I forget, but nonetheless, it's easily verifiable. And you always see in the movies where they bite the gold coin. Not only was it verifiable, but there wasn't a lot of it. It's not like you could just run out and find gold anywhere. All of these things kind of meet to support why it would be a useful commodity for money supply. One of the things that you would find out is that, for the most part, the people who were doing the bartering, as they were bartering for other goods to hopefully make their supply last longer, they were bringing their stuff to market anyway. And what would have happened probably is that as soon as you get somebody who has a little bit of force, who can kind of offer protection, I always consider government a protection racket, and so they offer protection, but they want to get paid. The thing is that they don't want to get paid in chickens and livestock or piles of lumber. They don't need to be paid in grain and corn unless they're going to use it immediately. They have the exact same problem. And so money also has that, where it's easily collectible for things like taxation and fees. But governments would have found out right away that you don't want counterfeiting. So, there's always that issue. But if you went to collect a commodity like copper and you tried to coin, well, you find out real quick that enough handling of these coins, whether copper or iron or what have you, depending on how far back in time you go, not all of them last real long. And it costs money, and it takes more commodities and time to mint more. You would go with something that didn't have to be redone over and over and over again. And once again, gold comes into play for that. Now, the interesting thing, so if that's, and obviously you can argue the support on that, it doesn't really matter. But all of these things behaviorally make sense about how people would try to preserve things and what they would end up having to do and resort to, because you didn't have paper and you didn't really have printing presses. The paper itself would have cost more than it would have been just to probably go out and try to mint a coin. As you kind of as you progress along, then, and you find out, okay, so the inflation part, commodities have a relative value to each other, and that really didn't become distorted until you started to get into debt-based fiat money. And you can see that. It's the interesting thing. Okay, prices are representative of time periods. And I know this is going to be a little bit abstract for some people to view. But prices are representative of value, but it's not just value. There are components in the price. Part of that is time period. Time period is going to be monetary and fiscal influences, and obviously the amount of currency that's out. And that's why people have always understood the supply of the currency to be inflation. And if all of a sudden the currency goes away, it's deflation. It's the amount of currency that's out there. And they've tried to change that definition by putting it into prices. But as I said, prices are not. Prices are a measurement of a time period of a given commodity, because value doesn't change in itself. It's all these other components that are mixed into the changes of the price. And from our perspective, mostly it's the devaluing of our currency and the other things like I was telling you about, interest rates and so on, monetary fiscal policy, whether it's taxation, interest rates, whatever. But the fact is that the behavioral aspect, and so this is going to be rolled back to what I was talking about, economics is behavioral. The value of owning your own home is still the same. You want the home because you want a place to raise kids, or you want to have a garden, or you want whatever that plot of land represented to you. And it doesn't matter if you were in the 1800s or the early 1900s or the mid 1900s or even today. The value of having a home hasn't ever changed. The time periods that it has been in has changed, and thereby the prices have changed. Those prices being influenced, like I was saying, by all kinds of other factors, mostly the medium by which you're actually exchanging for whatever it is that you're valuing. Prices are time period specific, and they've always been that way. Commodity to commodity is different though, and you can see this, and now I'm going to go on to the inflation part. You can see this when governments try to manipulate the money supply. You can go into, and you probably heard this, when governments all of a sudden decided they wanted to increase budgets, but there wasn't enough gold able to be sourced. And so the gold was being smelted or melted, or whatever the proper term is, with other metals. Well, people saw this and they knew this, so then prices increased. The interesting thing probably about that was not so much that it was being blended with other things, and because people probably didn't give two hoots what face or what number was printed on that, whether it was a 5 like a nickel or a 10 like a dime. They didn't care. They cared how much gold was in each, and the gold was the same relative to whatever commodity that they were selling. So if somebody had a quart of lumber, and that quart of lumber was one gold piece, it was 1 ounce of gold, and the government had been devaluing currency by mixing it in with other, mixing the gold with other metals. So now each coin only had a 1/4 ounce of gold in it. Well, that price of lumber went from one gold coin that used to be 1 ounce to now 4 gold coins, because each of them had a 1/4 ounce. It was the amount of gold that was actually contained in the coins, not just the amount of coins that were printed, although that did have an effect. But in a commodity-based system, that's the relationship that you're looking at. It's not just the total money supply, because you jump out of a gold-based or a commodity-based, it doesn't have to be gold, honestly. Anything that's a commodity that you can trade for. But like I said, those things have risk attached to them then. You have time that you have to spend it in, or time before it spoils. So that's why those things weren't used necessarily as commodities. But if you have a commodity that doesn't have those things attached to it, well then, that's what's being used, and that's how inflation is, when you start melting other things with it and it starts losing the total amount. You can go back and look at things like, I think an example was a suit in, I don't know, 1920s or 1930s, or I forget the exact date, but you could get a pair of shoes and a nice suit for a gold coin. And, you get pretty much the same thing today, roughly. It's a very close exchange. Like I said, the value of an item doesn't change relative to commodities. And that's the interesting thing. What commodities do is they limit what you actually can spend on things. And that's therein the biggest benefit of having commodities or commodity-backed notes. By that, I mean, if you have, not everybody wanted to carry around the gold coins, and this is where actually the bankers kind of screwed people. They'd give you a note and it said, you had 10 pounds of gold or whatever in the back, or 10 ounces of gold in the back. They'd give you a note. Well, people started trading the notes. The notes became as valuable as the gold itself because of what it represented. Well, then they started putting out more and more of these notes that were way more than what was actually in the vaults. And so, that's where kind of bank runs would happen, and currency crashes, and of course you probably would never hear most of this stuff. But nonetheless, that's what happened with the oftentimes, is that somewhere it was scheming that was going on. Now, the commodities force you to be fiscally responsible, because you only have so much of whatever it is the commodity is. The only time that changes is if there was, for example, a new mine was discovered or something like that. And then as they brought the gold back, well, then there would be eventually more gold would filter its way through the entire society and into the coffers. But that only happened if there was actually a new mine or something discovered. Now that brings up a good time to introduce the whole price specie flow mechanism. And I believe it was Hume who recognized this, and it was him, and I think Smith did as well. But they noticed that when a mine was discovered, and this is what kind of brought them up into the whole, if money supply increases, so does if it inflates, prices go up. And that's where that whole idea came from. But they noticed, so the merchants would bring it in, and of course the merchants, because it was gold, brought it in, and they would have it, stamped out, and the official stampers or minters would do it. And of course they do it for a fee or what have you, but they would have access to the money first, and then they would go and they would buy their luxury goods or spend their stuff, and then the people who were working on the luxury goods obviously got paid via that. If more money was coming in, and they were skilled at what they did, you'd get raises, and then that would then be spent on their stuff and their food, and other vendors that they would go through. And so very slowly but surely everything would flow all the way through the city or the marketplace or wherever they were at. But it always concentrated in the merchant area if that's where it came in. And then taxes would be collected along the way, and so it would enrich an empire or city if they allowed it to go through. Usually, what happened, however, though, is that government would, of course, want to steal more money that they didn't earn or have anything to do with, and so they would jack taxes up right away rather than wait for it to spread through the entire, in the exchanges. And then none of the merchants would want to show up at that port, and they'd go somewhere else, and the town would collapse and be poor. And it really did happen that way. But nonetheless, as you can see that the concentrations of where money would be is where all the wealth would be until it sifted its way through the entire economy. As it did, like I said, wages would usually bump up, and then, of course, prices would probably bump up as well, because everybody became behaviorally aware of the fact that everybody had more money, or there was more money accessible, so they would raise their prices a little bit. And so, it was a natural reaction to something that was coming in because everybody knew there was more money. Once again, it's a behavioral reaction. If you know people have more money, most people are going to inch their prices up a little bit, especially if you're individual craftsmen and you don't have a real set pricing strategy. Corporations now have set pricing strategies. It's kind of a little bit different, and their pricing is based upon all kinds of things like perceived value in the market or margins that they're desiring to hit because that needs to be the return on their capital or something like that. It's a little bit different when you go into craftsmen and artisans and they're doing individual sets for pricings. But you can kind of see it if you've done work with, say you were looking at a photographer, an artist, or something like that, and usually they do family portraits, and say they'll do the whole family, and they'll do a certain number of shoots, and it'll be $200-300. Okay, well now all of these stimulus checks went out. Well, now if their prices went up, and say now they're going to do it for $400 or $450. The reason why is because they know everybody has more money, and that's where it comes in. It's a behavioral component. And it's a reaction to things, and so part of it ends up being that when there's more money supply available. So to go back into your commodities, obviously, unless you get more gold or some commodities stockpiled up, you really can't spend more money without, like I said, mixing the gold with some other metal, and that there is your debasement. The debasement didn't come into play with the number that was stamped on the coin. Like I said, it was the amount of gold that was in the coin. That's where the debasement came from. And that's where you run into those issues when you're government, because you want to spend more money, but you don't have the money to spend. So the only way to get more gold is to raise taxes. Well, the only way for people to survive is then to move their goods somewhere else where they don't have to pay as high as taxes, because they're all trying to get along as well. So it's a very interesting dynamic with money supply. When you go into a fiat-based currency system, that's, plain and simple, it just ends up being theft, for lack of a better word. I'll probably have to explain that at a different time. But to go back into the, we'll roll back. I kind of jumped ahead a little bit with that. If you talk about hedging, hedging works because of the relative value between commodities. That's what hedging is, the idea where whatever you're going to lose in one place, you're going to gain in another place. Now, it doesn't necessarily have to even be, obviously related. Maybe you find out that every time something goes down, something else goes up. And it doesn't always have to be up by the exact same amount. You're hedging, you're just looking to make up for some of the losses in another area. And that's hedging, you're just looking to mitigate your losses. And that's what it really comes down to. Now, hedging with gold, in terms of commodities, it goes back to the fact that there's a relationship between commodities. And so the prices, when they increase for one, usually increase for all of them. Now, that varies a little bit because, once again, it's a behavioral system. It's whatever's being used. It's a supply and demand concept. And so hedging is relatable between commodities and whatever is good for a commodity during a given point of time. But that's just a relationship, and you usually wouldn't use two different commodities to hedge against each other. It depends on the situation. You would use, your hedge would be something like, you build houses, so you buy a futures contract for a certain amount of lumber, and if the price is going to go above that futures, what you can buy in the futures contract, well, then you're going to end up being able to buy at that price, and you're going to save that amount of money. If everybody did that. Now, that would be an example of a hedge. Gold is a hedge to rising prices. Just basically works in the fact that gold, or any commodity for that matter, it doesn't really matter what one it is that in a time when all prices are rising, because it doesn't always happen. You have things like you have supply issues, and you have behavioral context where if everybody thinks something's going to be running short, everybody runs out to buy it. It's how people react to things. Though behavior is a major component, especially when you're studying pricing, price changes, and purchases. And so the relationship between the commodities themselves, when all prices are rising, when you actually start getting into inflation, they will all go up together. Now, that doesn't mean they all go up by the exact same amounts, but they all go up together. So, and this is where you see when you start getting into places where they start seeing massive inflation and they start dumping their currency to buy whatever commodity they can. The reason why is because they're hoping, going way back to that whole idea about bartering, that somebody's going to want that which they have purchased. That's a actual commodity or a solid, material entity that you can actually use to create something else and create value once again. Because that's really what it comes down to, is that commodities are used. They're the base product that creates everything. And those commodities are then used, value, or the value can be other commodities mixed. It can be usage. It can be, brains and intelligence put into it. But it comes out on the other end where it's got more uses than it had at the start. And, hopefully that product, if it's really well received and it's got a lot of benefit, a lot of people do benefit from it and value it, that it's got a market. It won't collapse. Otherwise, if it doesn't, then it does collapse, and that was, those resources won't be wasted anymore on that product. Free market thing. But anyway, that's the idea with your hedge, that using other commodities against each other. If all prices are going to go up, all commodities are going to go up. That's just how it works in times of massive inflation. Now, there's a difference between inflation and hyperinflation. People are talking hyperinflation because we're at, say we're at 10, 12, 14%. Even up to 20%, that's not hyperinflation. It's inflation. It is not hyperinflation. Hyperinflation is a collapse of a currency. Now, hyperinflation is like, one day you're paying $2 for a stick of butter. The next day, literally the next day, whoa, it jumped to $5. Wow, well, maybe 2 days later, we're at 24. And the 2 days after that, wow, we're at 80. And then, it's by the time you hit 6 months, you're literally looking at $100,000 for a stick of butter. That's hyperinflation. That is what you're looking at. Inflation, we had 20% inflation at one point in time in this country. I think it was late 70s or early 80s, somewhere in there. Reagan term, right after Carter. And so we actually did see that. From that point on, it's been nothing but downward reducing interest rates is where we got this ridiculous credit bubble that has developed. There's never been increasing rates after that, maybe a couple bumps in there, but for the most part, you're sloping down all the way through. And so that's the difference between inflation and hyperinflation. The key component for hyperinflation that people don't really seem to understand, and if you actually go back to Weimar, point short, other people don't want your currency. And it's your trading partners for the most part. You can, if you were completely sustainable within your country, and the government just kept printing money, you'd have massive inflation. And, people would be paying $50 or $100 for a stick of butter or whatever. If you were completely sustainable and you didn't have any external trading partners, though, you probably wouldn't see hyperinflation unless the government was just nonstop running printing presses, and actually by the time you got through it, the paper would cost more than it actually, the numbers that were printed on it. And so it would take a great amount of effort to do that. The hyperinflation comes into play when your trading partners don't want your money swapped for their currencies. And so you're just left with this pile up, and nobody wants your goods. Nobody wants your cash to pay for goods. So then you are kind of like, you are self-reliant at that point, whether or not you like it or not. And the only thing you can do is trade hard goods for other people's hard goods. And so if they reject your currency, that usually means that any currency that has been built up over the time period all comes flowing back in. And that's where the hyperinflation comes into play. It's not necessarily that it has to be printed. It's already out there. And it's just like the U.S. Tons of countries hold treasuries. They hold treasuries because they need to use those treasuries to pay for other goods. There's a whole lot of commodities out on the world markets that you can only buy in dollars, oil, for example. But if all of a sudden they rejected the dollar, didn't want it, well, what would you do with that? You do the exact same thing that happened in Germany. You would swap all of your dollars that you possibly could for hard goods. And that's what you would do, because the dollars would still be taken in the country. So you'd swap them out, take whatever goods you could and say, no, we don't want any more, we don't want any more. You can just keep all this stuff. Well, then all the people you swap those dollars for, they would have all this built up money. Just like the example that I was talking about when the merchants brought in the new gold. And so for a very short period of time, all those people who have all these built up dollars would be able to spend it before the inflation really started to take place through the entire economy. But very quickly it would. And that would be because of all that money that rushed back, and everybody would say, oh my goodness, I'm raising prices. And, at first it starts off as a behavioral reaction to the fact that they know everybody has more money, and then eventually it just gets completely out of whack because nobody has any supply of anything, and that's where prices go up through the roof. And so that's kind of a relationship that you actually see when that happens. In our case right now, the government just went hog wild and printed and, threw out all of this money. And so now we're at that point where you're going to see massive inflation. And so we're sitting probably shadow stats, I think says, 14% or 12% or whatever it is. And so we're definitely going to see 20, 25%, maybe even 30%, but that's still not hyperinflation. I believe in Turkey right now, they're sitting at 18 or 20%. And some of the countries you can look at their bonds, and they all sit at 8 and 10, and that's usual what they sit at, whether it's like Russia or Argentina or Hungary or some, the countries with their bonds, they actually have normal interest rates. And so that's where we're going to see the hyperinflation aspect would be that combination of people rejecting the dollars, buying up all the goods that they possibly could, actually having supply shortages, and then all those dollars flowing back in. That would be hyperinflation. And that's the difference between those two things. And then, just since I mentioned this, I wanted to touch on the deflation part, because seemingly people don't understand the deflationary aspect either, or what happens. Deflation is the opposite of inflation. You have to have a complete contraction of the money supply. But that has to be a catastrophic contraction, and it has to have something to go along with it. Much like hyperinflation has to have other countries completely reject your currency and just swoop up all the supply that they can out of your country. Deflation has a specific set of events that has to occur as well. When people use the stock market crash in 29, they forget certain aspects that happened during that to create the events that caused a complete contraction. And so when you're looking at this, first of all, remember that during that time period, our dollar was still backed by gold. And so it was a commodity-backed system. And you have a limited number of dollars, number one. Number two, you can't just do crazy printing on stuff. And so people, really got into investing during that time period. And the central bank system had only been in play since 1913 at the time. So what was that, 16 years or so? As people started investing in companies, and the companies were really roaring, and they found markets for things, and it was a behavioral aspect. Once again, people started dumping their money in the stock market, and rather than just keeping their savings in the bank, they were able to get more out of the market. So they took it out of savings and they started putting it in the market, and of course it just drove up shares, and it ends up being a bubble. The shares were not worth what people were paying for them, but people just kept dumping their money in there because everybody always thinks sky's the limit. Then what happened was, evidently the bankers decided that was also true, and they were actually giving out credit on people's stocks, and so they'd give them more stocks, or more money of other savers, And because when people put their money in the bank, I mean, that's what the bank was giving out. And so they give people money that other people had saved. And so whether you saved or not, like it's all being dumped in, because that's exactly what it was. People would take out money, and then they would take out, just like today, they take out mortgages and they dump it in the stock market. And so you've got this whole big old bubble system building up, and it's a gold-based system. And so there's no printing money. There's no magic money that's coming from anywhere. And this is all actually all their money is representative of real labor and work. And then the whole thing crashes. Somebody decides to sell everything they have, collect up everything they've got, and take what they could. Market goes, and everybody who had participated in that, who didn't sell, got wiped out. And you have to look at the perspective where it wiped out cash, and all of a sudden all their cash was concentrated in a handful of people who sold. So people lost homes, they lost cars, and then obviously companies crashed because people weren't able to buy their product, and even companies were probably, they're investing in the market as well. And then you look at the banks. Well, the banks had loaned out all this money. The banks went bust too. Everybody went bust. And all of a sudden, all of that money that was out there just got souped up out of the market. And so if that money gets souped up out of the market and it only goes into the handful of a few people, and then those people don't necessarily make a whole lot of purchases in a whole lot of areas, that money doesn't, exist anywhere. It's gone. There is no more money in the market. And that was deflation. Like, there was a massive event where it was like, imagine a vacuum, and it sucks everything up right out of the market, and there is no more money for anybody to have. And honestly, there wasn't any physical money for people to have. The whole concept of banking comes into play, where you have to have, and I know there's discussions on this, banks function as distribution all the time, but there's a certain amount of truth to that. If you consider the fact, financial institutions aren't all bad, but financial institutions aren't all bad when they're actually reined in. The problem is that in 700 years, I think there's only been a couple of times. I think in Venice they were able to rein them in successfully for a brief amount of time, and I forget, there's another example as well. But for the most part, they're never reined in. They always go wild, which is why everything goes to hell in a handbasket. Pretty close to overtime here, so I don't know. Hopefully, you got a little bit out of that rambling on deflation, inflation, hyperinflation, commodities, and gold. So.